Why did you choose to write this book, Masters of Corporate Venture Capital? What are some top three takeaways from the book? I'd love to hear what are some of the common challenges you heard from the 50 CVCs you interviewed. What are some differences that VCs have compared to CVC?
The world of technology is changing quickly and it will not slow down. It's not going to stop. It's only going to keep changing faster. It's to how do I benefit from external innovation at other corporations and in the startup world where the fastest innovation is taking place. The corporate may understand exactly what you're solving for, where the VC on Sandhill Road might be interrupting the founder's response with a new question. And the founder walks out of the meeting saying, I don't think they even understand what we do. Whereas the corporate probably knew exactly what you do from the minute they saw your deck because they have the same problem.
Hey listeners, welcome to 10x Growth Strategies podcast. This is your host, Preethy Padmanabhan, technology executive, investor, and board member. Today, we will feature the book Masters of Corporate Venture Capital with the author Andrew Romans. Andrew is the general partner at 7BC Venture Capital, a top decile performing fund currently investing out of Fund 4. He has published 3 books in 5 languages with major publishers and is very close to finishing book 4. He taught venture capital as a university professor and is the host of the podcast Fireside with a VC. Andrew, how many things do you do? This is amazing to have you on the show. Welcome.
Well, thank you. And thanks for having me, Preethi.
Wonderful. I can't wait to get started. Tell us about yourself, key highlights from your career journey.
Sure. So very short, I started my career in Silicon Valley in enterprise software and very quickly founded my own startup, which raised venture capital funding, including corporate venture capital funding. So my first perspective on that book was on the recipient side of CVC or corporate venture capital. I had a number of startups which raised a few $100 million of venture capital funding and managed to experience bankruptcies as well as M&A, good exits, and even a NASDAQ IPO. And to keep it short, got into venture capital, and now I'm a VC.
So you changed sides, right? You were there getting money from VC and CVC, and now you're on the other side giving money to other entrepreneurs.
Yeah, at the time that I started my venture capital career, you could say first with the Venture Capital Equity Exchange Fund or the Founders Club. Most VCs had entered the venture capital industry from either consulting or investment banking. I guess these were people that were close to the LP community, and it was still somewhat rare to be a founder who even understands what it's like to be in her shoes, his shoes, and live through going from funding round to funding round, as well as all the things that you end up doing as a founder. So I feel like I still bring that founder expertise and experience. These days, I'm not so rare. There's more and more people that sold their company, made some money, and decided they're going to be a great VC and do it. But it used to be rather rare back when I got started as a VC.
And I think it's the right direction to go because then the entrepreneurs also feel connected and the VCs are able to be helpful to the entrepreneurs.
Yeah, I mean, there's a lot of things that if you've never, been a founder and ran a business and went through that whole experience, you may not even really understand what it's like to hire or fire a PR firm or people or any of this stuff. You may have just never done it, never had to. So I like to think I can be useful with my perspective of my individual founder experience. And it didn't all go well either. I know what it's like to go into chapter 7. I've done that, with a company. It's not just everything I touch goes to Midas Gold. And in any good VC portfolio, you should have something like 20, 30%, of cases where you did not get all your money back. And in some cases you get zero back. And it's good to have some compassion for all these people as they sail into that. Maybe they dodge the iceberg and they make it, or maybe they go down.
Absolutely. No, that's good to hear that broad set of different companies that you've been part of, and so many stories that the audience will resonate with to hear. So let's start. Why did you choose to write this book, Masters of Corporate Venture Capital?
Yeah. So when I wrote my first book, McGraw-Hill was the publisher for English, and it went out in a bunch of other languages. And the book was too long. And later, people said you shouldn't write the book first and then get published. You should write like a summary, get published, and then go write the book. I was kind of taking that founder perspective of bootstrap your startup as much as you can before going to the VC. Put some points on the board with revenue and then raise money. And so I finished the book basically, but the book was too long. So I had to cut Europe, I had to cut the Middle East, I had to cut corporate venture capital, which was a important chapter. And I thought to myself, CVC should be book number 2. And I can see that, this is not Napoleon with 10 volumes. It needs to be somewhat concise in a 200-page plus so book. So I was hoping that would be book number 2. And then it was long before the decoupling or kind of combative thing of the West and China. Huawei, I was a telecom entrepreneur to begin with. And so I know a lot about telecom. And after the dot-com crash and the end of the golden days of vendor financing, where you could raise, you could get like $100 million out of Lucent or Nortel or Ericsson, build a mobile network. And after you have revenue from subscribers, you pay back the debt to the vendor, like Ericsson, Lucent, Nortel. After the crash, the only option in town was the Chinese. And so there was the China Development Bank or these municipal sovereign wealth funds in Shenzhen that were backing Huawei. So I knew Huawei very well. They asked me, saying, Andrew, you're the only VC we know in Silicon Valley, and you understand us really well. Could you advise us on forming our corporate venture capital business unit? And I jokingly said, that's the one thing you didn't copy from Cisco. And that's like the defining thing that makes Cisco the greatest, that they invest in VC funds, they cherry pick, they get all this information from their GP VCs they work with, and then they know to, test out that technology and be the first to innovate with external innovation. And, anyway, so Huawei, I said, let me do a case study. I'll interview the 20 largest corporate venture capital business units like Intel Capital, Motorola Ventures, Microsoft Ventures, and those guys. And I'll give a report to you of how they do it. And I'll ask them each, what is going wrong? What would you do differently? And what's bad and what's good? And what settings would you change if you could? Now, I'm not really able to put all that in the book because it exposes, large corporations for doing things foolishly, really. But I was able to give that to Huawei, and then they could go off and do whatever they wanted to do. At a minimum, stop wasting time and get your CVC up and running, and avoid mistakes that are typical Shakespearean, timeless. Everybody makes that mistake. So that was, and I said to them, I'm going to do a better job for you than anyone would ever do, because I'm going to use this as the nucleus for my book, Masters, which will have 50 case studies. And then after I was long done with Huawei, I had CVCs that I didn't even know asking to be in the book because they had heard about the first book, did very well, was top 10 for a long time. And so people wanted to be in the book. And I was like, look, if the CFO of Chevron is cold calling me, asking that we include Chevron Ventures in the book, let's just let this magic networking thing continue. So it was beneficial to me as an active venture capitalist to develop our C-suite network with kind of the Fortune 1000 or so, and meet more people. So there was well more than 400 face-to-face meetings that resulted in what went into the 50 case studies of the book. But that's the backstory.
Love it. And I love that fact that you had so many different case studies and shared so many different perspectives on that Huawei piece. I used to work for Cisco. That was one of my early jobs out of school, undergrad. And we used to joke we used to put some bugs in the code so that it will also show up in Huawei. Uh,
Oh, yeah, right. Yeah. Like, hello. I mean, there's a joke of, do you know what copyright means in Chinese? And I regret making this joke on a podcast already. In Chinese, it means right to copy. And and so, maybe you shouldn't hand them the cookbook by filing the patents so that they see exactly, how you do it. But, there's a quote, I think I have it in the book. I forget actually, but I once heard an interview with John Chambers. So I had raised $27 million from Lucent in the Rich McGinn days for my own company, the Global Tele Exchange, the GTX. And so I was paying attention to guys like John Chambers, then CEO of Cisco, and I saw an interview with him. And they go, "How do you think you can compete with Bell Laboratories, Lucent, when they have something like 40,000 engineers, and you've only got 6,500 engineers?" And Chambers said, "Well, those guys are in New Jersey. Mine are primarily in Silicon Valley. I'm also a limited partner investor in 54 venture capital funds here in the Valley, and they see everything that's happening. And if you look at all the engineers that work for all those companies, with all that innovation flowing into the Cisco business and driving our M&A decisions and our build versus buy and partner decisions, Bell Labs cannot touch us. They can't even catch up to us. And how are you supposed to think out of the box if you're in a box, in a cubicle?
Mm.
We're out up and down 101 and 280 in the Valley. We have access to the best, smartest people from the IIT and everywhere. And I thought that was pretty compelling, So I think the topic of CVC, corporate venture capital, is fundamental to the survival or failure of countries at the nation state level. I think it's essential to the survival of large corporations if they're going to benefit or be victims of technological change. And our politics globally might be a disaster, but technology seems to be accelerating faster than in the early days of our careers, Preethy, right? It's just moving faster.
Wow, great story there, Andrew. I loved it and loved the reason why you decided to write this book. And I'd love to hear what are some top three takeaways from the book.
Sure. And I'll confess as well that one of the motivations to write the book was to better understand why corporates want to have a corporate venture capital program at all. What are their objectives? Because usually, if you're like $100 billion company, making a return on an investment, is a very small part of your business. That's not really why they're doing it. They tend to be doing it for strategic reasons, as well as maybe trying not to lose money, which is a topic into itself. What's more important, financial returns or strategic returns? And part of the thesis in writing the book and getting it into other languages was to be able to work with corporates as LPs in our fund so that we can kind of bridge between the startup and the opportunity of partnering or distributing or collaborating or even selling to a large corporate. So good for the startup, good for the corporate, and a differentiator for our fund.
The question was like, what are some top three takeaways? And you codified it well. It's good for the startup, it's good for the corporate venture capital arm, as well as for your firm.
I would say top takeaways from all the research and all my experience as well. And let me also say that I had raised money from VCs for my own startups and interacted with many of them on that side. I've co-invested with a lot of VCs over a decade plus career in venture capital. And I've raised money, from corporates. And then a lot of corporates have asked us to advise them. So we were at first foolishly saying, we're not consultants, we're VCs, invest in our fund and we'll help you. We then thought, okay, we can advise you as a corporate on how you should approach CVC or fix your CVC or make it better. And this has given us huge insight. I would say every human is unique and every startup team is unique and every corporate is unique. Some of them are going up and just growing like crazy, like Salesforce under Mark Benioff. And then some of them are like Ericsson in Sweden, where they're number one in wireless modulators, but in a declining market. So, does Vietnam need a sixth and seventh mobile phone network? Probably not. And so for a company like Ericsson, they're thinking, how can we use corporate venture capital to become number one in data centers, which is a high growth market, and somehow, ride the coattails of our, wireless networking business. Time Magazine has got 74 printed publications that are all going to zero. What's their strategy to not go bankrupt? So for some companies, it's like, oh, what do I do with this extra 800 million of cash that my business is throwing off in Singapore or Indonesia? And other ones are like, if I don't do something, we're going to go bankrupt. So it's a different thing for everybody. I would say the biggest takeaway is that the world of technology is changing quickly, and it will not slow down. It's not going to stop. It's only going to keep changing faster. And what is your strategy as a large corporation? And you could define what's large enough to be in this, but it's to, how do I benefit from external innovation at other corporations and in the startup world where the fastest innovation is taking place? And how am I going to do that? And then make a list of, in the book in chapter 1, which is available for free, and we could put a link that anyone could download that for free in the show notes of this episode, is a list of every bullet point of the top answers I got when I asked over 400 CVC executives, why do you do this? Why does Microsoft operate a CVC? Why does Intel have one? Why does Salesforce Ventures have one? Why does NTT Docomo have one in Japan? And I took all their answers and just started putting them in bullet points of a million different reasons. And I think a healthy exercise, if you're a corporation, if you have a CVC or not, and you're thinking about it, and basically everyone either has one or they're considering launching one. There's almost nobody who's saying, we've decided to do nothing here. That's very few people. They might not have their act together and have launched it, but they're talking about it. And then there's a bunch that are in the process of canceling one, and it'll get reborn in a few years later. This is inevitable. So I say, take the list of all these benefits of why other people have, and kind of whiteboard circle in a strategy session the ones that apply to your unique. Are you Ericsson, number one in a declining market, trying to get into the data center space? Are you Time Magazine, trying to not die? Or are you some monster business like Salesforce that's just generating cash and trying to decide what to do and be a leader in AI, not a victim of AI? And then once you make your constitution of what are the core goals and objectives of our business, and back to the why are we doing this? And then let that be your guide to avoid maybe takeaway number 2, which is that individual career ambitions of individual people at the corporate typically take the car that was heading in the right direction and do a U-turn and start driving quickly in the wrong direction. So individual career ambitions tend to corrupt, like the board of director level, what was the goal of doing this? And if you've got a strong constitution, you can stop that from going wrong. And you can also steer the board that was literally shackling and preventing the individuals in the CVC business unit from being successful on things like compensation. It's very upsetting to the CFO, who may have been with a corporation for 37 years, to be writing a check of $25 million as a bonus to some gal who's only been with the firm for 17 years. And she's now in the CVC, and she made a profitable investment in Wiz, which was sold to Google for, a ransom fortune. So big takeaways are they should do it. Then is, what are your goals that are unique to you? And then let's understand everything that typically does go wrong. And let's understand why they go wrong and what the answers are. And you can also take an audit of your existing CVC and benchmark every decision you've made. And did you make the wrong decision repeatedly on 100 different questions? Do I go left or do I go right? Should we be investing off the balance sheet, or should we get off the balance sheet? How do we handle compensation? What are the geographies? What are the stages? There's just a million questions to be made. And you can kind of figure out, is it possible to adjust all these settings in the cockpit of your business unit? Or should we just carry on with a very dysfunctional manner, which is better than killing it completely? Very often, it's impossible to get the board of directors to green light the right decisions. They usually are more red lights than green lights, in my experience. But there are some that are really optimized and doing so well. And these are, you're going to see the Ciscos that are destroying the Lucents.
Yeah, I think this is a very strategic advantage, it looks like, for all the corporates that decide to invest in it, and can be used for different goals, as you said, right? Different companies might have different objectives. And I loved all the examples you gave earlier. You talked about Cisco using it as a way to get the cream of companies to acquire, versus somebody like Ericsson trying to save their market share in a down market. Great inputs on what are some reasons why a company should start CVC and what are some of the benefits. I'd love to hear what are some of the common challenges you heard from the 50 CVCs you interviewed.
Well, something like 80%, if not more, almost like approaching 100% of the people I interviewed for the book are no longer working at that corporation. Whereas if you look at the 108 episodes of VCs, like our friend Venk, that I've interviewed on my podcast, it's very rare for anyone to leave their venture capital firm. If it's working and you're making money, you stay there, and it's hard to recruit that person away from there. So I think staffing, there's usually the wrong people put in charge of running it to begin with, and compensation is a problem. If you don't pay them well, the bad ones stay and the good ones leave. And so compensation is a real problem. Other problems are like, if imagine a 200-year-old trading house from Japan, and then imagine Jeff Bezos at Amazon. Bezos is a natural experimenter. He started off selling books and DVDs and music on the internet, where if I buy that in Tower Records, the Rolling Stones CD, it'll be the same as if I have it delivered to my door. I don't have to try on women's jeans to see if it fits or not, right? Then he got into lawn furniture and women's jeans. And I thought, that's crazy. My wife tries on 50 pairs before she decides which one to buy. Even she'll get 10 of the same size to see which one is the right fit. But he just ran these experiments like a laboratory Eric Ries lean startup experiment, iterated, and then he ends up in like AWS, owning his Hollywood studio. There's so many businesses the guy got into. He's just experimenting and funding things. He's looking at externally. I mean, he's got his own reputation for just destroying people that get in his way. But how can you take the mindset of a Japanese corporate and inject yourself with a blood serum in your veins to make you more of an experimenting Bezos? And a big mistake I see is the large corporate says, well, I only want our CVC to invest in the buzzword topics and sectors directly related to the products and services we sell today. So if they had Amazon Ventures in the beginning, they would have kept the business in the business sector of selling books and DVDs on the internet, and you never would have had, Prime Video and AWS and all these other business units. And what they should do is recognize we employ 100,000 or 50,000 people, and we should be considering anything to improve the lives and lower churn and attrition, and how much does it cost to provision someone into this business and brainwash them to think like us, and that we should not be limited to investing in startups directly related to the products and services we sell today. Businesses do a lot more than just sell whatever it is they sell. They have a lot of other operations that could benefit from the change that's happening in technology. So it's a pretty common mistake that they have a failed strategy of what to invest in. And I almost give up on trying to change their minds. It's almost impossible. They only want to see investments into things that they can make some line to strategic fit with what they're doing. I would argue that there is strategic fit to, think outside of the one sector you're in or the one adjacent data center sector, you're trying to get into. Investment committee can be an issue. The IC, they often have people on the IC in the beginning that are like the CFO of a multi-billion-dollar corporation, and you're sitting there trying to decide, should we make a 75K investment into a pay-to-play where your shares are getting swapped from 99 shares to one share, and you're getting wiped out, and they can't wire in time because the CFO is off buying a company in India for $1 billion and needs to read every memo in great Jimmy Carter detail, and the IC is dysfunctional. Or they have the head of R&D, research and development, on the IC, who looks at everything the startups are doing and saying, actually, we've been working on this for a few years ourselves. And even if they haven't, and that's not true, he or she thinks they can make that in a couple of months. Why should we invest in that startup? I can easily do whatever the hell Zoom is doing. That's open source software as far as they understand. So the IC is often a problem, as well as the people they hired at first to begin with. And, we could go on and on. Another classic one is you really want to be off balance sheet for a million reasons, of how you get in and how you can divest and how you account for it. You don't want to get stuck with, we cannot own more than 20%, because then we have to consolidate all their financials into ours as a publicly traded listed company on the NASDAQ or something. I would say everyone can improve. There's no such thing as a CVC that couldn't take an audit and improve what they're doing and better hit their strategic goals or their financial goals. Even measure, if the CEO usually says, I only care about strategic. I don't care if I lose $100 million a year. I want to acquire one business that turns into a multi-billion-dollar recurring revenue stream via corp dev M&A. Who cares if we burn all the cash? Whereas the CFO is like, hey, if this thing starts losing money, you're all fired. I'm going to terminate this endeavor. I count how much the money that left the CVC as an investment and how much comes back to me as a distribution. The CFO is more into financial. And so everyone should find their unique balance of strategic versus financial and what is correct for us. And you should get the board to sign off on it, and it should almost be framed on the wall. So later, when people are making bad decisions, you say, hey, buddy, our Constitution says, and we all agreed, these were the goals and objectives, and we agreed on this. Get out of my way. And there's a lot of infighting.
Yeah. No, great insights there. I heard a few things. One was the whole hiring and retaining talent piece, and then the aspect of being strategic versus focus on the money piece. Lots of very good insights, and also alignment within the company between the CFO and the corporate venture capital firm in terms of returning the money, right? I think because I mentioned I was at Cisco earlier, and they were acquiring companies all the time. So we would always talk about like, okay, how many acquisitions did we take down versus how many of them actually survived? And there was one time when I was in a meeting where we had John Chambers do a presentation, and he was talking about some of the efficiencies that had been built in the CVC, which is to do an acquisition within 45 days, right? That was like a huge win for the company, because they used to take 6 months to actually do even an acquisition and integration. So how do you make it successful? So great learning lessons there.
And by the way, Frederick Rambeau is a good friend of mine, worked for Alan Patricof, founder of Apex and Greycroft, who I've had on my podcast. Frederick, after working for Alan Patricof at Apex, joined Cisco in London, where Cisco was getting half their revenue from Europe and was paying enormous tax to repatriate that money back to California. And so they hired Frederick, my friend, Rambeau, to run Cisco Ventures Europe. And he invested in 54 venture capital firms across Europe in 1 year. He got his commitments in and immediately was pulling out of all their portfolio companies of who was doing what, who was going to raise a round, anyone doing anything related to any of their topics. and that information was flowing back. They ended up doing M&A in Israel, M&A across Europe, so that the money never even had to flow back. And they were super tax efficiently balancing out the company and getting employees to the level they needed. France was kicking Cisco out of France if they didn't hire X number of people. And so rather than hire a bunch of worthless people that they cannot fire with French labor laws, they started investing in VCs, acquiring startups where these are gladiators. Like, one Spartan could kill 300 Darius the third people. It was just a beautiful thing. So Cisco really rode the wave better than almost anybody, during an era.
Oh yeah, yeah, that's amazing. Great story. I didn't know that part about how Europe, grew, and I was involved personally in some of those global international product deals we had, including even South Korea. That's good to hear. Well, we talked a little bit about VC and CVC. What are some differences that VCs have compared to CVC?
I mean, it's hard to generalize, what do all men want? What do all women want? You're not going to be very correct when we're all so unique. So, what Microsoft Ventures or Intel Capital want is very different than Salesforce Ventures, for sure. But in general, the investment committee is looking for strategic and financial returns on every investment that they make. And they may be going through a period where the CVC has broad freedom to move quickly, and they no longer need a signature of approval from the head of R&D and the CFO of the corporate conglomerate. It might even just be a small handful of people or one in the business unit of the CVC making the decision. Typically, it's going to take longer, and it's going to be more of a process to receive a wire transfer from a corporate venture capital business unit compared to a purely financial VC, like say my firm, 7BC Venture Capital. We can decide in a moment's notice to make an investment in wire the same day if we wanted to. Now we have a process, but comparatively, it's different. So, and historically, in the olden days, it used to be that corporates wanted to see the company funded by financial VCs who are professionals at that, and they come in around Series C when the company is looking for large partnerships to really scale. And so and then historically, the CVC was not allowed in their charter to be a lead investor. So you needed to secure another VC as your lead investor, and then after you have that, you could add in a strategic that you think adds value and you want the money. But if you're purely looking at getting cash, as a startup, you're probably better off talking to financial VCs than you are talking to a CVC. Now, I said that was kind of ancient times. In more modern times, you see CVCs launching an accelerator program. And if this startup is on Series C, there's probably already a copycat in China and a copycat in Germany and a copycat in Singapore. And the word is out. There's no secret here. Are they really benefiting from external innovation by joining the Series C round when the company's got 50 million of annual reoccurring revenue? Maybe you've already missed the boat. And so we've seen some CVCs come down much earlier and being able to invest off a balance sheet, not having a dysfunctional IC investment committee, and being able to make a quicker decision and fund the company and potentially even lead. And I know some CVCs that seek to take board seats, which is another conflict of interest, thing to be considered on a deal by deal basis. Sometimes if the CVC corporate invests in your company, like let's say Cisco, and they decide Cisco wants to acquire your business, they want to buy the startup for the lowest price they can get it for. Whereas my fund wants to sell the business as well as the founders for the highest price we can get. And so you might not want Cisco to have a board seat to vote against raising a $100 million funding round, doubling sales, and force Cisco to pay $6 billion as opposed to $3 billion, to buy the company. So there's pros and cons. There's benefits to be had. the best thing is to understand them before you make an irreversible decision, and think of what's the best way to do that. Some CVCs, like City Ventures, who I've had on the podcast talking about this very question, they say, well, if I introduce the startup to Citibank and Citi decides they want to buy the startup, I just recuse myself as a board member from that. And, his ability to introduce the startup after funding them with cash to a buyer of the business, recognize a conflict of interest and move out of the way, that's adding more value than some greedy investment banker who's taking 6% or more for having just made an introduction and maybe didn't have the ability to get the CEO and the CFO on the phone on a Sunday morning. So I think there's a lot of problems here, but if you understand this, how complex and the complexities here, and then come up with some working policies of how to behave when you hit one of these situations, this can operate really, really nicely. And if you just blanket cover your ears and say, no, I'm not going to ever let a CVC invest in my startup, which Fred Wilson from Union Square Ventures famously said on a rant, which you can find on YouTube, that he would never, 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 ever, never let a CVC invest in any of his portfolio companies after the horrible behavior that he's seen. I think that's wrong. I think that just understand this up front far before you smash into it and have policies of how to navigate conflicts of interest.
It's very interesting, right? That whole startup versus the investor, having that relationship and having that ability to trust and building the right guardrails and the path forward to how you behave in certain situations. Very wonderful, really an insightful conversation there, Andrew. Are there any tips for startups that are looking to raise from CVC? Like, do they have to focus on the strategic part of how the CVC will benefit? What do they have to do differently?
Well, I think it depends what you're trying to achieve. If you have an opportunity to raise money from, say, MDI Ventures or Telkomsel in Indonesia, if you raise money from Verizon Wireless Ventures in the United States and they invest and become a shareholder, you will probably find that you've shut the door to ever doing business with AT&T Wireless, T-Mobile, and what was Sprint. So that's an irreversible decision that could limit your revenue. On the other hand, if you are not signing all of them up, just shutting the door to the others and only locking in revenue with Verizon might have been the correct thing to do. If you raise money from Telkomsel, they're the biggest in Indonesia, 200 million people. It's like 5 times bigger than Verizon on the number of handsets. And the internet in that archipelago nation is the mobile. Like, if you don't book your mortgage on the back of a moped, it's never happening. So to be able to get distribution onto all those handsets is worth more than most VCs and their gentle egos in Silicon Valley of how highly they think of themselves. So I think that sometimes a founder could say, I'm going to reach out to strategic corporate venture capital groups to invest in our financing round without even planning on accepting their money. I just want them to route this to the correct purchaser and business unit to do a trial, and POC and start using my software now. And if that goes well, then we'll consider accepting money in our next funding round. But we will not take any money from you until you can prove that you can get a business unit within the conglomerate to work with us. And, a big problem is the CVCs fail to get their actual conglomerate to work with the startup. I've seen some naive CVCs say 100% of the time we make an investment, we're doing business between the conglomerate and them. That is not true. It's impossible because the people running these business units, some Japanese guy who's been at the firm, whatever, you pick it, Toyota, is not about to tarnish her reputation by putting this startup from California into the car, So there's going to be big resistance, which is a big issue in itself. How do you get CEO to drive every head of a business unit to work properly with the CVC and give financial incentives for that to even happen? to achieve those goals on that constitution of what you're trying to achieve, to begin with. So I think for founders, there's a big opportunity to raise capital, to bring strategics into your business that could give you a lot of legitimacy with customers. If your salespeople have on the slide, we're backed by Intel Capital and Sequoia, your customer may never have heard of Sequoia, but they have heard of Intel Capital, or they've heard of Intel. They're like, you must be legit if you've got the backing of Intel and Microsoft, and Oracle kind of thing. But on the other hand, I've had CVCs hand me their business card in Silicon Valley, and it says head of investments and corporate development. And I'm like, ooh, the same person who makes the decision on buying my company is the person who makes the decision on investing in my company. In a perfect world, there's a Chinese wall between CVC and M&A, and you control when you let a top 5 candidate to buy your company in the end know everything that's under the hood, what your revenues are, what your bank balance is, possibly vote on your board of directors on selling to their arch nemesis competitor. So, startup beware of dancing with elephants and wolves that could destroy your business, and maybe you're better off just selling to them. On the other hand, there's no harm in controlling the information that you're sharing, and meet with them and attempt to get a distribution deal and revenue, and maybe never take their money unless they can convince you and your board to accept their money. So I think it's foolish to just say no, never, 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 never. I've also seen some startups get funded by corporates when the financial VCs would not fund them. So right now, every Silicon Valley VC and their dog only want to invest in artificial intelligence, B2B software that's growing at 4x year over year, blah, blah, blah. And you come up with your IoT manufacturing optimization deal, and they say, well, our government sold out our manufacturing base a long time ago. Maybe you should go to Germany with this thing. And so lo and behold, Germany has corporate venture capitalists running up and down Silicon Valley, and they might be much more excited about funding your business than the lemming pack that's all chasing the next OpenAI deal and doesn't care about your manufacturing deal. So sometimes you're better off with a strategic corporate who gives a damn about what problem set you're solving for. And that could be a good thing. I've seen some startups fail to raise money from strategic investors because the valuation is stupid. And you look at what the liquidation stack is, you got to pay off 200 million of funding you've already raised, and you're burning money like crazy. What's the how many months runway do we get from this 5 million? You'll be out of money in 9 months. And the head of the CVC doesn't get paid, whether this thing goes bankrupt or turns into a 100x investment, because their compensation is messed up. And they don't care. They just want to they haven't made an investment in 12 months or 18 months. And they just want to show I made an investment related to flying cars for this automotive conglomerate that I represent. So I've seen the unfundable get funded. I've seen the unfundable raise money at valuations that make no sense to a financial investor trying to make a cash on cash return commensurate with the underwriting of the risk. I've seen founders get money out on a secondary on a strategic deal that never would have been tolerated by, a financial VC. So I think it's not bad to communicate with all the different parties in the ecosystem and make your own decisions, and just be a little careful on making irreversible decisions that you will not be able to change later. And you may find that you now are directly in touch with the CTO of a multi-billion-dollar company. And maybe that relationship will help you with this business, even if you never took their funding. And this might not be your last company. I had 3 different venture-backed startups, and there was people I was meeting on startup number 1 that were very useful for startup number 3, and they're very useful to me now as an active venture capitalist.
That's great insights. In fact, my husband's company has raised money from one of their customers, right, through corporate funding, as VCs would not touch a telecom focused company if they're all, like you said, chasing the AI and the next big open AI deal.
Yeah, the
So they,
corporate may understand exactly what you're solving for, where the VC on Sandhill Road with her freshly minted MBA from Stanford might be interrupting the founder's response with a new question. And the founder walks out of the meeting saying, I don't think they even understand what we do. Whereas the corporate probably knew exactly what you do from the minute they saw your deck because they have the same problem, you know? So it's a very different experience. So you might feel really good about talking to a corporate investor, especially if you're in one of these topics that the Chinese VCs, of course, they're chasing all manufacturing deals, but we're really not in the US. It's hardware is hard.
yeah, it is. Well, it was a pleasure having you, Andrew. Any final insights for the audience?
Yeah, I would say that the world of CVC, when done right, should have the support of the largest corporations in a specific country. So even looking outside the United States, who are the CAC 40, the 40 biggest companies in France? And today the Olympics are getting started. They should be more worried about those 40 companies going bankrupt or getting beaten in the open market than creating the next Cisco, Nokia in their relatively small country of France. So I think it's about surviving and winning as a country to be figuring out how to almost force your corporates to have a corporate venture capital business strategy, modeled after Cisco, modeled after Telefonica in these kind of case studies. I think that if you are the large corporate, this is not something that is a nice to have. This is do or die. You have to do this. And your strategy might just be fund to funds and cherry pick and work that, or it could be fund to funds and invest directly and boost your M&A. It could be about your HR. Who should we be hiring, and how should we be training our existing workforce with what we're learning and the intelligence we're getting? To hell with Gartner Group and McKinsey. This is where the information's coming from. The future is pitching VCs today, and so you get to see the future from it. So there's a long list of bullet point benefits of why to do it. So for the corporate, they have to be in this in some way, at a minimum fund of funds, if not FOF and direct. And then they need to understand all the things that can go wrong. From the startup level, you want to do business with partners like Telkomsel in Indonesia that can grow your revenue and get an international footprint of customers that'll completely change your M&A exit price, either as an IPO or M&A. But you want to be careful, of how you do that, with examples of I shut the door by opening this door. So I think it's good for startups and VCs to have relationships, have lunch twice a year with each one of these CVCs, and be able to introduce your portfolio companies to these large corporations that can invest, and carefully warn people of the dangers before it's too late. And, no one's forcing us to take their money. And if they're charming enough to get us to take their money, that could be worth more than any VC trying to burst your revenue. They have a magic wand. They have hundreds of thousands of employees sometimes. Other corporations around the world, might see, oh, if you signed up Telefonica, then I can sign up British Telecom and Telkomsel, and then the dominoes will fall. So I would say the stakes are high for a win-win-win, a win for the founder, a win for the financial VC who knows how to harness this, either as LPs or co-investing partners, and a huge win for the corporates. And, governments seem to impress me less and less than politicians, but politicians and governments should understand what's at stake, and they should be encouraging, if not forcing, this to happen.
Mm-hmm. Yeah, makes a lot of sense. Thank you for that holistic picture you gave us. Again, it was great to have you, Andrew, on the podcast. Listeners, check out the book, Masters of Corporate Venture Capital. And thank you for tuning in today. And thank you, Andrew, for joining us.
Thank you, Preethy. Good to see you. See you soon.